Okay, it's time to start our discussion of bonds, boring bonds, stodgy bonds, reliable bonds. And we begin with a quote from none other than the steel magnate of the turn of the 20th century, Andrew Carnegie, who said, "Gentlemen prefer bonds." And of course, this was many years before the movie Gentlemen Prefer Blondes. And why did Andrew Carnegie say this? Well, because bonds are far less risky, far more reliable than stocks. Of course, what do we know about risk versus return? Right. Less risk, less return. And as we get older, bonds are a more important part of our portfolio. But as far as I'm concerned, for younger people, they really shouldn't be invested in bonds. But there are others who say, "Oh no, you don't understand. Payano's too risky, and you know me, I'm not that risk tolerant to begin with." No, everyone needs some bonds in their portfolio. So we'll discuss this more when we get to diversification, when we tie everything together in chapter 11. So let's get started on bonds. Yeah. Okay. I'm ready. I'm ready. I got to get myself excited because they're bonds. Slide number 2. What are bonds, by the way? They're the negotiable, publicly traded long-term debt securities. There's that word again, securities, a tradable financial asset. They're loans. You can think of them like a mortgage. The issuer agrees to pay a fixed amount of interest over a specified period of time and to repay the fixed amount of principal at maturity. Hence, we often call bonds fixed income investments, fixed securities, or just fixed. Because we know what our interest rate's going to be. We know what our principal repayment's going to be. Unlike a stock where we don't know, you throw a number up in the air and maybe we're close, probably not. Bonds are also called debt financing, as opposed to stocks, which are equity financing. Right, you're lending money to the entity as opposed to becoming part owner of the entity. It's just an IOU. It's a loan to corporations, corporate bonds, state and local governments called municipal bonds, and of course the granddaddy of them all, the United States Treasury, treasury bonds, or government bonds. The bondholder loans money to the bond issuer. So you're essentially playing the part of the bank. You are making a loan. Investors who buy bonds are loaners, LOANERS, as opposed to part owners when you buy stocks. That's why we call them equities. You're part owner. The trust indenture on slide number 3 is the contract that sets forth the terms between the issuer and the bondholders. It describes the bondholder's rights and the issuer's obligations. In other words, you're going to pay the interest and pay the principal back. They appoint a trustee to oversee that the obligations are carried out. And the trustee is usually a commercial bank or a trust company. And in the trust indenture are protective covenants, which are the provisions that say, hey, the bond issuer has to keep doing business, has to keep equipment in good working order, make their payments on time. And sometimes there are other covenants, such as the covenants, the stipulations, the obligations of Southwestern Community College. We went to the voters and said, hey, we need to renovate the campus, destroy all the old beautiful buildings and put in ugly new buildings. But hey, that's what we're doing. And the voters said, sure. But part of the trust indenture, part of the covenants, was that we would use this money to build new buildings. We can't give ourselves a raise or throw a party or whatever. And there's the trustee that makes sure that we do what we said we were going to do. And we have done pretty much what we said we were going to do, and with not the greatest results, but hey, it's what it is. Slide number 4. Why invest in bonds? Well, bondholders receive interest during the life of the bond. Bonds in the United States normally pay every 6 months. So in our class, we'll always use 6 months. Although some pay every quarter, some pay every month, some pay yearly, but we'll always use the typical bond that pays every 6 months. The principal is redeemed when the principal is returned when the bond is redeemed, and that's usually, 5, 10, 20 years, 30 years, but it can be as little as 1 or 2 years. But usually we're going to see that those are called notes. They're not actually called bonds. With the big difference, I don't know. There's a potential for capital or gain or a loss. Wait a minute. This is a loan. How can the loan's value change? Stick with us. Because if interest rates fall, there's a potential for a capital gain, but there's also a potential for a capital loss if interest rates rise. Huh? This is the trickiest part of bonds, and we're going to discuss it in detail, so stick with us. However, if you intend to hold the bond to maturity when you are paid back the loan, then you don't care. The capital gains, capital losses do not affect you. Some bonds offer tax advantages. We're going to see that muni bonds are not taxable at the federal level, and federal bonds, treasury bonds, are not taxable at the state level. And some bonds can be converted into stocks. They're called convertible bonds. Now, doesn't that sound sexy? Convertible, wind blowing through your hair with the top. No, they're not really that exciting, and we'll deal with those later in a future chapter when we discuss hybrid securities in detail. Slide number 5. Bondholders are first in line for repayment if there is a default on the loans, if the company goes into bankruptcy. Well, not really. Got to pay the taxes and the payroll expenses, but usually the taxes are nothing because the company has been losing money, and of course everybody has to get paid their payroll. Who's at the end of the line? Right, the stockholders, right? That's why when a company goes into bankruptcy, usually the stockholders wind up with nothing, zero, where the bondholders get to pick the carcass first, and they get whatever they can. The bond prices are far less volatile than stocks, but bond prices still fluctuate. Bond prices go up and down, can go up and down, and do go up and down when interest rates rise or fall. And so we're going to discuss this in detail. It's the trickiest part of bonds, but we normally don't buy bonds for the capital gains or losses. We buy bonds for the income, the interest. And what have they returned over decades? Well, you go back in time and you see that they've returned anywhere from 2 to 6%. Some bonds pay more. Treasuries and municipals typically pay less than corporate bonds. Well, that makes a lot more sense, right? The government is more stable, typically, than corporations. And some corporate bonds pay much more, and those are normally called junk bonds. Currently, many bonds are paying less than their historical returns. A few are paying more, but since 2022, when interest rates started to rise, bonds are paying more along the lines of what they paid in the past. Not quite as much, but pretty darn close. For many years since the Great Recession, since the global financial crisis, bonds were paying very little. In fact, I would tell people, anyone who would listen, look, I can't get excited about a 30-year Treasury bond paying less than 3%. But that's how much mortgages were, right? Some of you were lucky to get a mortgage at 3%, maybe 3.5%. Not bad. What are they now? Oh, 6.5%. So yes, interest rates have risen dramatically since 2022. And we will discuss this in further detail along the line. Slide number 6, bonds versus stocks. Okay, over the long term, stocks have outperformed bonds, right? Over the long term. There are certain times when bonds outperform stocks, typically during a recession and there's a market downturn. But why, if we know that over the long term stocks have outperformed bonds, why invest in bonds? Well, first of all, stocks are more volatile. We've found that out, haven't we? And so if you're the kind of person who doesn't like that volatility, you're going to be more interested in bonds. Bonds offer an element of stability to our portfolio. So, some people use the term ballast. If you know anything about shipping, you put the heaviest things at the bottom of the boat to keep or ship to keep it from rocking. And some investors, the stocks are just simply too risky. They reason if I can obtain my long-term goals without taking on the risk of being invested in stocks, so be it. I can sleep better at night. Factor, right? Do you want to eat well or do you want to sleep well? Bonds also make good intermediate term investments where stocks are good long-term investments. 3, 4, 5 years. And sometimes bonds are just screaming good deals. Yeah, sometimes bonds. And as we're going to see, at the depths of the Great Recession, there were phenomenal stock deals and there were very, very good bond deals. And we'll see that in one of the ancillary presentations. The risks of bond investing, because remember, every investment has risks. Well, there's interest rate risks. When rates fall, bond prices rise. When rates rise, bond prices fall. It's a seesaw that we're going to hammer at you multiple times. But again, if you intend to sell the bonds in the future, this could be a problem. But if you don't intend to sell your bonds, if you're going to just continue to earn the interest and then get the principal back when the bond matures, you don't care. You don't care what happens to interest rates. There's purchasing power risk, which is another word for inflation risk. This is the risk that your purchasing power will fall if inflation outstrips your return from bonds. And we find that over time, bonds have done better than inflation, but nowhere near as well as stocks over the long term. And then there's always the risk of what's called default, business risk, financial risk, default risk. They all mean the same thing. The entity can no longer make their payments. This is certainly a problem with some corporations. It's much less a problem with municipals, and the United States Treasury has never defaulted other than certain politicians jumping up and down saying we're going to default if we don't get our way. But no, the United States is going to pay its debts, dear students. That's why that's why we really love muni bonds and treasury bonds for their very low default risk. Although some municipalities have gone belly up during the Great Recession, the global financial crisis, a few municipalities around the country went through bankruptcy. All the bondholders got paid, so they had to make sure that everything got paid. But it was I'm sure the people who were holding the bonds were a little nervous, but no, everybody did get paid. Slide number 8, liquidity risk. This is remember the idea that you might not be able to find a buyer for your bond? There's a risk that you may not be sufficient buyers when and if the investor wants to sell their bonds. If they want, they don't have to sell their bonds. They can just hold them to maturity. But this is less of a problem with treasuries and munis and most corporate bonds. What we're going to find, though, or if we become bond traders, is that most people don't trade their bonds like stocks. They buy their bonds and they hold on to them. So this is sometimes a problem from the buyer's point of view, not the seller's point of view, because they would love to buy these bonds, but nobody's selling them because they're hanging on to them and earning their interest. So it's not a big problem. And then there's the risk called call risk or prepayment risk. This is the risk that a bond will be called away from you before its scheduled maturity date. So think about it, folks. If you have a mortgage or maybe you have a car loan or something, or maybe a credit card at a high interest rate, and you have the ability to refinance that bond, not bond, that loan, either a mortgage or a car loan, or find a credit card that has a lower interest rate, you would really love to do that, wouldn't you? Right, you're going to pay fewer dollars in interest. And the same thing is true for bond issuers. If interest rates have fallen, they're going to want to refinance the bond. And so that means they're going to call the bond away from you, such that now you get your money back, thank you very much, but now you have to go out and find another loan, and it probably won't be paying what you were receiving. And that's called call risk. Now, we're going to find that some bonds are non-callable, which means the issuer said, yeah, don't worry, we're not going to call these bonds away from you. Well, typically, right, they're right, they don't have to pay as high as interest rates because they don't have that risk. They don't have that call risk. So they get to pay fewer dollars in interest at the time the bond was issued, but they don't get the opportunity to call the bond away from somebody. And we'll talk about the call feature of some bonds in a bit here. Now, bond interest and principal. Where are we? Slide number 9. The coupon. What the? What is coupon? It's called the nominal rate, the coupon yield, the nominal yield. This is the feature of the bond that defines the amount of annual interest, and it is fixed for the life of the bond. There are a scant few bonds called floaters where the interest rate can rise or decline, but we're not going to deal with them. We're just going to think of all the bonds in our universe, as fixed. Now, where did the term coupon come from? I mean, that's ridiculous. Well, bonds used to be documents that people would trade, and they would have, literally paper documents that had coupons attached to them. And when the 6 months was up, because they usually paid every 6 months, although there were a few paid quarterly or yearly or monthly, but in this class, as we said, every 6 months. So every 6 months, you would clip the coupon that was come due, put it in an envelope, send it off to the issuer, and they'd send you back a check. That doesn't happen anymore, dear students. It's all electronic. But to this day, earning interest from bonds is often called clipping the coupon. You'll hear people say, yeah, I got this great bond. I've been clipping this great coupon. And so they're not actually doing that anymore. But think about it, folks. That made, before electronics, right? That made trading very easy, because all you had to do was give the document to somebody else, the bond, and they pay you for it. And then they can start clipping the coupon and writing in their name and address, and then the issuer would send the check to them now. See that? It was a way to facilitate trading of bonds, but it's all gone. But you, dear investment gurus, have to understand the term clipping the coupon. Slide number 10, the principal, the amount of capital that must be paid at maturity, the amount of the loan. And it's often also called par value, face value. Typically, bonds are sold in $1,000 increments, $1,000 denominations, sometimes called pieces. I've heard that from bond professionals. Yeah, well, there's some bonds that are 5,000 and 10,000, but we are always in this class going to use 1,000. So bonds are denominated in $1,000 increments. So putting the coupon rate and the principal together tells you how much interest you will receive every year. For example, a coupon rate of 7%, principal 1,000, gives us $70 of interest. A coupon rate of 3% with $1,000 gives us $30 of interest. You see, it made it easy to understand how you were going to get paid. You knew if you had a 5% bond, you're going to get $50. If you're going to have a 6% bond, you're going to get $60. Well, actually, you get every 6 months, so the 6% bond would pay you $30 and then $30, but you get the idea. And since almost all bonds are denominated in $1,000 increments, knowing the coupon rate gives you the amount of interest. Therefore, normally bond investors simply refer to their bonds by their coupon rate. They say, I got a 7% 30-year bond. That means for the next 30 years, I'm going to get $70 a year, $35 twice a year. And then at the end of the 30 years, I get my $1,000 back. You see how that works? It's a little different than what we think of when we think of a loan. When we get a loan from a car loan or whatever, every month we pay a little bit of interest and we pay a little bit of the principal, right? It's mixed. Not so with bonds. Typically, there are a few bonds that work that way, but not in our class. It'll always be interest only until the bond matures, and then we get our $1,000 back. That's how most bonds work. Slide number 11, maturity date. This is the date on which a bond matures and the principal must be repaid. Most bonds are what we call term bonds. They mature all at once. They're the most common. For example, the company will issue 20-year bonds that all mature in 20 years on the same date. Some bonds are what we call serial bonds. They have a series of maturity dates. For example, a company may issue a series of 20-year serial bonds with 20 maturity dates, each series maturing each year for 20 years. So each year, see, this is more like what we're used to, right? This is more similar to what we're used to, where every year a certain amount of the principal will be paid down. But that's not typical. Serial bonds are not typical. And typically you will know, this bond, it's a 20-year issue, but my bonds are going to mature in 5 or 8 years or whatever. Sometimes there's a lottery. I'd never seen this, so I read about it. I don't know about it. But some bonds have a lottery, so you really don't know when you're your bond is going to mature. So I don't know if I'd like that if I were a bond buyer, bond investor. If I'm going to buy a bond, I want to know when it matures. So with term bonds, you know. With serial bonds, you typically know, but be careful for the ones that may have a lottery where they decide, oh, these people all get paid this year, and you're kind of skunked, right? That was in the provision, in the trust indenture. They were able to do this, and so you're got to do it. Slide number 12. This is where I think things get a little silly. Bonds versus notes. Technically, there's a difference between a bond and a note. Notes mature in 2 to 10 years. Bonds mature 10, 20, 30 years. Some bonds mature in 50 or 100 years. We're going to see some Ford bonds that don't mature until 2097. There's a very small number of bonds that never mature. They're called perpetuities, which is a great word, because you get to spit on your friend when you say, I just bought a perpetuity or a console. In practice, most investors, including myself, just use the term bond to refer to both bonds and notes. But if you're talking about the 5-year Treasury note or the 10-year Treasury note, the bond, I'm sorry, you say, oh, I just bought a 5-year Treasury bond. And they say, oh no, that was a 5-year Treasury note. Tell them to stick it in their ear. No. You say, you're absolutely right. I'm sorry. I always use the term bond for both bonds and notes, and so does 99% of the rest of the people in this world. Slide number 12. Okay. Slide number 13, I'm sorry. We're getting back to this call provision. The call provision is the ability of the bond issuer, the corporation, the municipality, the Treasury has never issued callable bonds. But this provision specifies whether and under what conditions the issuer, that's the corporation or the municipality, can retire or prepay or call the bonds away from the issuer prior to the investor. Call the bonds away prior from the investor to the maturity date. If interest rates drop, as we've said, just as the homeowner would want to refinance their mortgage, a bond issuer would want to refinance their bond loans. So the issuer says, okay, come here, bonds, come on in. The issuer calls in the bonds, and the bond investor is given their money back. They're not going to steal the bonds from you. They got to pay you, but now they have prepaid the bonds and you're not going to get your interest payments anymore. All other factors equal, and they never are, investors would prefer the non-callable bond to the callable bond. But there is the rub, right? Non-callable bonds are typically going to pay fewer dollars in interest because they have that provision. They have that provision that they can't be called. So callable bonds will pay more, but you might get them called away from you as an investor. There are three types of call provisions. There's freely callable, non-callable, and deferred call. So, okay, makes sense here. Freely callable can be called away at any time. They're not typical. What's more typical are deferred calls. There's a call protection period or a call deferment period. The issuer has to wait 5 years or 10 years or whatever time frame until they can actually call them away. And of course, non-callable means they can never be retired. So most corporate and municipal bonds are either freely callable or, more typical, they say, okay, in 10 years, we're going to be able to call this thing away. Treasuries, so far, the United States Treasury has never issued callable bonds. Which of the above provisions is the least desirable? Obviously, freely callable. Most desirable is non-callable, and deferred call is somewhere in between. So please do study that, because as investment gurus, you need to understand that. When someone says, somebody took my bond away from me. Oh, they were called away from you. Oh, I'm sorry. Here's how that works. The call premium is the amount that is added to a bond's par value and paid to the investors when the bond is retired. You could think of it like a prepayment penalty on a home mortgage or a car loan. For example, the premium might be $85, which means the issuer has to pay you the $1,000 plus the call premium of $85, and so that would be the call price. It's the price the issuer must pay to retire a bond prematurely. It's equal to the par value plus the call premium. And if there is no call premium, the bond is said to be callable at par. Par value being another name for the principal, the face value, par value. Those bonds are callable at par. There's no prepayment penalty. And we're going to see this in action when we take a look at some of the advertisements. It's a separate presentation, but of course in the face-to-face class we would show it in as part of the presentation. But you're going to go check out a couple other ancillary auxiliary presentations that show you these advertisements and say, hey, this one has a call premium, this one's callable at par. Slide number 16. Okay, this would be a good time to break. Okay, hey, because here's the trickiest part of bonds, and that is bonds and interest rates. So come on, pause the presentation for a second, stretch, yawn, because oh my goodness, this is a really tricky part of bonds. It's the part, it drives everybody crazy because it's a seesaw. By far, the most misunderstood feature about bonds is their inverse relationship with interest rates. When interest rates fall, bond prices rise. When interest rates rise, bond prices fall. So if you just think of the seesaw, interest rates fall, bond prices rise. Interest rates rise, bond prices fall. Think of the seesaw, or draw it on a piece of paper, and it will, I think, it helps me. It helps me a lot because it's very simple to get confused. And, you hear people who've been in the industry for years just mess it up because if you zig when you should have zagged, you're going to get not the right result. Premium versus discount bond. You see, the bond was initially sold at par value, $1,000. But at any time into the future, it's not typical that it's going to be resold or worth $1,000. It may be a premium bond, and this occurs when prevailing interest rates have dropped, your bond is worth more because interest rates fall, bond prices rise. Or your bond might be a discount bond, which is a bond with a market value lower than the par value, face value, principal value. This occurs when interest rates have risen. Bond prices rise. Interest rates rise, bond prices fall. But this also occurs when and if the investment community believes that the bond issuer is in danger of defaulting on their interest payments or their principal payments, in which case people just start selling the bonds to get rid of them. They don't want the hot potato. They don't want to be holding on to the bond when the company goes into bankruptcy. So that's why another reason why bond prices may fall. If there is no premium nor there is a discount, the bond is said to be selling at par. So you're probably asking yourself, I know I did when I thought, it doesn't make any sense. Why would a bond sell at a premium or a discount to its par value? If the loan is for $1,000, the bond would always sell for $1,000, right? No, it doesn't work that way. You see, the interest rate on your bond doesn't change. It is fixed. And since the interest rate doesn't change, the price of the bond changes to reflect the change in the prevailing interest rates within the financial industry. Remember the image of the seesaw? Keep this in mind as we take a look at some examples. Here's an example. You buy a bond paying 10%. The bond's face value is $1,000. You're getting $100 a year. Well, you're getting $50 every 6 months. Now interest rates fall to 8%. You see, new bonds are only paying $80. People buy a new bond for $1,000. They're only getting $80. So investors have to pay $1,250 to get the same amount of interest that they would have gotten with your 10% bond. So are you going to sell that bond paying 10%? When other people are for $1,000, you're going to sell for $1,000. When other people are paying $1,000 and only getting $80 a month, no, you're going to demand a premium. The result is your bond is now worth more than it was. If you sold it, and you don't have to sell it, folks, you could hang on to the bond and keep earning the 10%. But if you were to sell it, you could sell it at a high premium. Now, would it go all the way up to $1,250? No, and there's a reason why, but it will be worth more than $1,000. The same thing happens on slide 20 if the interest rates rise, but in reverse. If the bond is paying 10%, you're getting $100 every year. If interest rates were to rise to 12%, now new bonds selling for $1,000 are giving the new investors $120 worth of interest. See, they only have to pay $833 to get the same amount of interest, $100 every year. Now, if you were to try to sell your bond, nobody's going to buy your bond for $1,000. They can buy a new bond paying $120. Your bond's only paying $100 a year. So your bond is now worth less. You would have a capital loss if you sold it. You do not have to sell it. You're under no obligation to sell it. But if you were to sell it, you would not get the $1,000. Your bond would be selling at a discount. And it wouldn't fall all the way to $833, but it would fall. It depends on how long it is until maturity. But it certainly would fall from $1,000. Okay, now go back over these two slides 2 or 3 times to make sure you understand the seesaw. Bond prices rise, interest rates rise, bond prices fall. Interest rates fall, bond prices rise. It's a seesaw. And on slide 21, it turns out that the amount of the premium or discount is not only related to the amount of the fall or rise of interest rates. In general, the greater the fall or rise in interest rates, the greater the premium or discount. The maturity date is also very important. The longer the maturity, the greater the premium or discount. Now think of the seesaw. I mean, it works. I remember when I used to play on the seesaw, like last Tuesday. I like to get in the middle here while two other people were on the other ends, and you go up and down just a little bit, right? But if you're way out on the end and somebody jumps off the seesaw, whoa, right? You're going to fly up in the air or fall down really quickly. And that is why, dear students, back in chapter 2, when we were looking at mutual funds, long-term bond funds were more volatile than short-term bond funds because the potential for a greater rise or fall in the capital in the value of the bond was greater because it was this more of a fall when interest rates rose and more of a rise when interest rates fall. In fact, as you get closer and closer to the center, you're basically getting closer and closer to money markets and treasury bills and the like. Just like the seesaw, the farther out you are, the greater the rise or fall. This is why long-term bonds are generally riskier than short-term bonds. Does this make sense? I hope so. Think about it. Think about it. I know it's a little tricky, but think about it because it makes perfect sense when you keep that idea of the seesaw in your mind. So here is a graph that tries to show you. Now, you don't really know because you don't really know exactly how it's going to perform because there's people buying and selling these things. There's market forces involved. But as we get closer and closer to maturity, here we're out 30 or more years. If the interest rates the interest rates fall, If interest rates fall, the farther out we are until maturity, the higher the price is going to go. And likewise, if the interest rates rise, the farther down we're going to fall. But as we get closer and closer to maturity, the bond prices will converge until finally, when the bond matures, we're going to get our $1,000 back. Does this make sense? Again, you gotta think about it for a little bit, cogitate, pause the presentation. There's no rush because this is important. This is the trickiest part about bonds is that seesaw relationship, that inverse relationship between interest rates and bond prices. Slide number 23. In general, long-term bonds exhibit greater price volatility and a greater opportunity for capital gain or loss. Intermediate term and short-term bonds exhibit lesser price volatility and, of course, a lesser opportunity for capital gain or loss. Bonds very close to maturity act very similarly to short-term investments such as treasury bills and corporate paper and money market accounts. However, again, if you intend to keep your bonds until they mature, you don't care. You're not concerned about price volatility. You will always receive the par value, the face value, the principal of the bond, except in the rare case of a bond default, and then it's a whole different world. They have to find out how much they can actually pay you. Usually you get paid something, and often, depending on the situation, especially in the case of a municipality, you're going to get all your money. But there's no guarantees. You might not. Make sense? I know you're going to have to go over this section, starting with the relationship, the inverse relationship of bond prices and interest rates, because it's the trickiest part of bonds. But once you get, I find as long as I keep that image of the seesaw, I might say it wrong, and I often do. Dyslexia strikes at any time. But I usually get the idea. Cool. Slide 24. So now let's revisit a slide we saw way back in chapter 3 when we were taking a look at the relationship of stock yields, dividend yields, with bond yields. And going back to 1960, we see that bonds were yielding, this is the 10-year Treasury note. I call it the 10-year Treasury bond. Yielding a little bit more, a little over 4%, and stocks were yielding about 3.8% or so, which was their average over decades. And in the 1970s, we talked about the very difficult time for the United States economy with the baby boom generation coming of age, and then lots of shocks culturally to the system and economically. and inflation started to take hold. There was a brutal bear market in 72 and 3, and we see that bond yields started rising tremendously because bond investors hate inflation. They want more yield. And the stock yield went up. Why? Because the prices went down. So the yield goes up if the dividends don't disappear. And to the point where we had a very scary situation with inflation running at 8, 9, 10% in the United States, which is a lot. It's a huge amount for us. And we talked about the then President Jimmy Carter, who just voted at age 100, and Paul Volcker, the new Federal Reserve chairperson, saying, "Okay, Mr. Volcker, you do what you need to do," similar to what Biden said to the current Jerome Powell, federal chairperson. You do what you need to do to kill inflation. Well, Mr. Carter, it might cost you your election, and then, of course, it was one of the reasons. The other reason was the Iran hostage affair. And sure enough, they racked up short-term interest rates. So I think that at one point the Federal Reserve rate was 22%. And T-bills were paying over 20%. Yeah. And for a very short period of time, mortgages were 17%. The 10-year note was 15% or so. And it caused the worst downturn since the Great Depression, 1980 and 1982. It's ancient history now. But then we see what the subsequent Federal Reserve chairperson, Ellen Greenspan, said, the great moderation. We see interest rates falling dramatically. What happens when interest rate, right? Bond prices go up. Bond investors were really giddy. And we see the stock dividends going down. Why is that? Because the prices were going up until finally in 2000, the S&P was, as a whole, as an aggregate, was paying 1%, which it had never paid that little. And people thought, the world, yay, we're all going to get rich, 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 rich. Internet bubble bursting, stock prices. Some of the stock prices went up. The old economy and the new economy, you don't hear that too much anymore. But bond yields still falling until 2008, when the wheels almost fell off after the housing crisis. And stock yields went above bond yields. Now that usually means it's a great time to buy stocks. But but you're afraid to do that because the world looks like it's about to end. And sure enough, it turns out, in hindsight, it was a great time. And then we see them both bouncing along until bond yields were just falling to unprecedented levels. And I was just looking around saying, oh, the interest rates can't stay this low forever. They just can't. We know they're going to go up. We just didn't know it would take a global pandemic to create the situation where interest rates needed to go up. And sure enough, in 2022, the Federal Reserve had to forestall the inflation-induced, pandemic-induced inflation with higher interest rates. And so now we see bond yields back up to pretty much where they were back in 1960. So you'll hear bond investors saying, hey, bonds are back. Now, what about stock yields? No, they have not come back to 3% or so. They're still down below 1%. 2%. They're not down below 1%. That was 2000. That was year 2000. So many people say that stocks are in a bubble, and a few stocks I think are pretty bubblicious, as they like to say. But a lot of them aren't. I don't think all of them are, but I definitely find it hard. I personally am finding it harder to find very screaming good deals, which probably means that we're due for a downturn. But do you know when it's going to be? No. Do I know when it's going to be? No. Does anybody know when it's going to be? There's a lot of people who tell you they know, but I don't believe them. And, they might be right. Eventually, they're going to be right. There's some people who tell you there's going to be a crash every year. They say that. And then they say, I correctly predicted it back in 2008. But you also predicted it in 2001, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12. Yeah, right. So we take a long-term perspective, and we realize that if the world ends, it doesn't matter whether you're in stocks or bonds or beanie babies or pork bellies. And as we'll get to gold, people say, well, you should have gold then. Well, we'll see. Gold might not be very useful in those situations either. So go back over this presentation. Make sure that you understand the aspects of bonds that we discussed here, especially the interrelationship, the inverse relationship of interest rates and bond prices. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. And in our next presentation, we'll get into more of the details about specific bonds. And yes, bonds are kind of boring, kind of stodgy, but they're also very reliable. Thank you so much for being in our class, dear students. We are so proud of you. Think of, oops, I didn't mean to do that. Think of how much I didn't mean to do that either. I apologize. Think about how much you have learned. My mouse is really, really sensitive, and I gotta bite the bullet and buy another one. Thank you again for being in our class.